Hello friends, so welcome back. Friends, we have discussed the monetary policy tools, especially the cash reserve ratio. Now we will discuss more. So this reserve ratio, these reserve ratios are called variable reserve ratios, right? So this variable reserve ratio means the CRR and the SLR, right? So both CRR and SLR combinedly they are called the reserve ratios. We will discuss the open market operations also and bank rate also, right? So in this particular session we will be dealing with all these, out of which CRR we have already done, SLR we will discuss, CRR versus SLR we will discuss, open market operations we will discuss, and the bank rate we will discuss. After that we will come to the liquidity adjustment facility, which includes both the repo rate and the reverse repo rate. Then we will come to the repo rate versus the bank rate, then marginal standing facility, then market stabilization scheme. Now coming to the statutory liquidity ratio, right? Statutory liquidity ratio, right? So this is a ratio. Ratio means the percentage of something, and here it is basically the percentage of the NDTL, net demand and time liabilities. Liquidity, so the purpose of this ratio is to maintain the liquidity, that is to maintain some assets which are very near to cash, right? So this liquidity has to be maintained, and this is done through some statutory measure. So this ratio is one of the statutory measure. So what is statutory liquidity ratio? So banks are supposed to have a percentage of their NDTL in the liquid form, and this liquid form can have cash, gold, or the government securities. So this amount can be kept in either of these three form. Now this government security is very crucial, right? Since the bank can purchase the government security from this amount, this forms one of the major source of funding for the government securities. What does that mean? That means majority of the amount of the SLR, it goes to the government securities. So government or the RBI, it always keeps SLR very high so that there is a permanent source of funding for the government securities. The government securities like treasury bills, right? Now who decides the rate of SLR? It is the RBI. Then how much is the percentage of SLR? So earlier, before 1990s, it used to be more than 35%. It is coming down slowly. After 1997, it came down to around 25%, and at present this is just 19% of the NDTL, right? What is the purpose of SLR? Again, the purpose is, number one, maintaining the liquidity, number two, act as a source of funding for the government security, and third one, maintaining the solvency of the bank. So whenever the customers come to the bank and demand their money back, the bank should have some of the assets with themselves. And very crucial thing, that this SLR amount has to be kept with the bank itself. It is different from CRR. In the CRR, the amount is kept with the RBI, but here the amount is kept with the bank itself. So let us see, SLR refers to the percentage of NDTL of a bank to be kept with itself before providing credit to the customer in the form of liquid assets such as cash, gold, and select government securities, right? So this amount will be kept with the itself. This is very crucial. Most banks keep the SLR in the form of government approved securities, specifically central government bonds and the treasury bills, as they give a reasonable return. So here you can see the example. Suppose this person is Mr. A. He deposits rupees 1000 with the bank. Now bank will maintain, for example, 20% SLR. So this 200 rupees will be kept in the liquid asset, and for example it is kept in the government security. Now this 800 rupees is the balance, and the bank can use this balance for lending or for other purposes, right? One of the very unique thing about the SLR as compared to the CRR is that there is interest income. So do you remember, in case of CRR, the RBI will not give any interest income to the banks. So RBI will keep the money of the bank without giving anything in return. But SLR, in case of SLR, the amount is invested in the government securities, and the government securities give the interest income. So this interest income is one of the important aspect of the SLR, and this is one of the major difference between the CRR and the SLR. Who determines the SLR? It is the Reserve Bank of India. What are the aims of the SLR? Number one, to control the bank credit. Yes, so the control of money supply is very important aspect. In fact, this is the universal goal of the all monetary policy tools. So controlling the money supply is first one. Maintaining the solvency. Solvency means whenever customers come to demand the money back, they can get the money back. So the bank is solvent, it is capable enough to return the money back. And third one, compel the banks to invest in the government securities. So SLR is one of the major tools through which the banks are made to buy the government securities. So whenever government wants to raise the fund, this SLR comes as a major rescue. Now, which are the institutions who are supposed to keep this SLR? One, all the commercial banks, which include scheduled banks and the non-scheduled banks, primary urban cooperative banks, state and central cooperative banks, right? So the cooperative banks and both scheduled and scheduled commercial banks are supposed to keep the SLR. So friends, if you are not aware about the difference between the scheduled and unscheduled, do not worry. I will discuss everything when I discuss the chapter of banking. Coming back to the SLR, so we in India, we also have a new category of banks which is called differentiated banks. These differentiated banks, they include number one, the payment bank, and number two, the small finance bank. So the payment banks have to keep 75% of their deposits in the SLR eligible securities. Friends, please keep in mind, this SLR eligible securities does not mean that payment bank has to maintain 75% is the SLR, right? So when I say 75% SLR, that means the bank can keep in the gold, in the cash, or in the government security. But as per the RBI norm, it is not the 75% SLR. Rather, this is that they have to maintain 75% only in the securities, not in the cash or not in the gold. So please be careful. This can be one of the area which can be asked in the examination. Next, small finance banks, they have to maintain both the CRR and the SLR as per the RBI norms. That means the small finance banks also have to maintain 19% SLR, just like other banks. So you can see historical data about the statutory liquidity ratio. So this is the data from the 1950s basically, and this is the data approximately around the 1990s. So in the 1990s it used to be more than 35%, right? And at present in January 2020 this is just 19%. So now this is just half of the amount which prevailed around 30 years ago. So now rate of SLR is just 19%. So out of every 100 rupees, 19 rupees is kept in the liquid assets, which can include cash, gold, or the government securities. Now the relationship between the SLR and interest rate and the inflation rate. So this relationship will work just as the CRR, right? So how SLR works? How SLR works, right? So when the RBI increases SLR, suppose earlier this was 19% and the bank increases this to the 20%, right? So what will happen? 1% amount will be blocked into the government security. 1% extra amount will be blocked in the government security or in the cash or in the gold. The bank will have less money for lending the business. That means they can also increase the lending rates to maintain the profit margins, right? Because they have to maintain the profit margin, so they can also increase the lending rate. That means interest rate in the market will increase. When the interest rate increases, that is the cost of money increases, the less number of customer will come and less number of customer will borrow. That means the interest rates will rise, overall the interest rate will rise, money supply will come down, right? So money supply will come down. That means the demand for the goods also goes down. When the money supply goes down, demand for the goods also goes down. And definitely when the demand for the goods goes down, the inflation also goes down. So inflation is controlled, right? So SLR increase means interest rates are increased and money supply is decreased, and vice versa, right? So in case of high inflation, SLR will be increased. In case of deflation, the SLR can be decreased. Now let us see UPSC question. So be happy. 2014 question. In the context of Indian economy, which of the following is or are the purposes of statutory reserve requirement, right? So statutory reserve requirement, this is not SLR. Please be careful. This is a statutory reserve requirement. It includes both CRR plus SLR. So when you are reading the question, be careful. Read each and every word carefully. So SRR is equal to CRR plus SLR, right? Statement number 1, to enable the central banks to control the amount of advances the banks can create. Statement 2, to make the people's deposits with the banks safe and liquid. Statement 3, to prevent the commercial banks from making excessive profits. And statement 4, to force the banks to have sufficient default cash to meet their day-to-day requirements. Now these are the 4 options. So take 30 seconds and decide what is the right answer, and then we will start again. So coming back, let us discuss each one of the statement. Statement number 1, to enable the central bank to control the amount of advances the banks can create. Yes. So controlling the money supply or the bank credit is one of the option. So statement number 1 is correct. To make the people's deposits with the bank safe and liquid. Yes. Maintaining the liquidity and the safety or solvency is the concern. So statement number 2 is also correct. To prevent the commercial banks from making excessive profits, this is not a goal, right? So this was never a goal. to force the banks to have sufficient vault cash to meet their day-to-day requirements. This is also not the goal, because in case of SLR, the banks can also invest into the government securities. So the purpose is not to have sufficient vault cash. The answer is option B, statement 1 and 2 only. Now, in this case, the answer will be B, option. Next question, 2015. When the Reserve Bank of India reduces the statutory liquidity ratio by 50 basis points. So what is the meaning of 50 basis points? That means 0.5 percentage, right? Which of the following is likely to happen? A. India's GDP growth rate increases drastically. B. Foreign institutional investors may bring more capital into our country. C. Scheduled commercial banks may cut their lending rates. Option D. It may drastically reduce liquidity to the banking system. So coming back, option A, India's GDP growth rate increases drastically. So reducing the SLR means more amount is available for the money supply, right? But this drastical term is very, very dangerous, right? We cannot say that SLR will increase the growth rate drastically, because growth rate is dependent upon lot many factors. FII may bring more capital. This is also not directly linked. There is no direct linkage. Scheduled commercial banks may cut their lending rates. Yes, they can cut their lending rates, because when they are supposed to keep less amount of money in the SLR, that means they have more money to lend. And when they have more money to lend, that means they can increase the lending rates. So this is quite possible. Option D, it may drastically reduce the liquidity to the banking system. No, it will not reduce the liquidity. It will actually increase the liquidity. So what is the right answer? Right answer is option C. So in this case, the answer will be option C. Scheduled commercial banks may cut their lending rates. Now, next question. This is very simple question. Which of the following terms indicates a mechanism used by the commercial banks for providing credit to the government, right? Answer: cash credit ratio. There is no such ratio. Debt service obligation, liquidity adjustment facility, statutory liquidity ratio is the answer, right? So this provides credit to the government. How? So when commercial banks, they buy the government security, so in return they give the money, right? So this money is given to the government. So government gets the money, or it gets the credit, right? Let us see the differences between the CRR and SLR. So CRR is the ratio of deposit banks have to maintain at RBI, and SLR has to be maintained with itself. This is very crucial. Next, a CRR will be maintained in the form of cash only. SLR can be maintained in the form of gold, cash, or other securities as well. CRR, it controls the flow of money, and it helps to meet certain demand of depositors. CRR, the banks don't earn any interest. In this case, the interest is earned on the SLR. So this is the summary. CRR means percentage of money which the banks has to keep with the Central Bank of India. It has to be maintained in the form of cash. It controls the excessive money. It is maintained with the RBI. It regulates liquidity, and banks don't earn any interest. In case of SLR, bank has to keep a certain percentage of their NDTL in the form of liquid assets, and these liquid assets can be gold, government securities, or even cash, and it has to be kept with the bank itself. It helps in meeting out the unexpected demand of any depositor by selling the bonds. It regulates the credit growth, and the banks can earn the interest on the SLR. So can you see the clear differences between the CRR and the SLR? if we see the overall rate of the CRR versus SLR, so since last 10 years, since 2010, in 2010 the rate of CRR was approximately 5% and now it is approximately 4%. CRR in 2010, SLR in 2010 was 25% and now it is 19%. So can you see both of them are decreasing? That means the government wants to increase the liquidity as much as possible. The next concept is open market operations. So I know that you keep reading the newspapers on a daily basis, right? And you come to know about this term from the newspaper. So just to test your knowledge, I am giving you 1 minute. Think about what is open market operations and then we will discuss about this concept. So what is open market operations, right? So can you see market? Market means any place where the activities of buy and selling happen, right? And this is open market. That means the operations are done openly. The operations are done openly, right? That is, the buying and selling happens openly. This open market operations is one of the quantitative methods to control the money supply. And here the RBI, it buys or sells the government securities to control the money supply, right? So how does it work? If there is excess money supply in the market and the RBI wants to control the liquidity, so RBI, it will sell the government securities, right? And friends, the government security is one of the instrument which is very, very easy to sell because it is completely safe. It provides stable returns also. So it is very, very easy to sell the government security. So RBI sells the government security and the banks, they buy the government security and in return they give the money back to the RBI. So they give the cash to the RBI. So as a result of this transaction, the banks have less cash, and since they have less cash, so their loans also reduce, right? And either they will reduce the loan or they will increase the interest rate. In both the cases, the money supply will come down, right? So can you see a direct link? So if RBI sells the government security, that means the money supply will come down, and vice versa, So this is very, very simplistic operation. So can you see over here, if there is excessive money supply, right? If there is excessive money supply, that means the inflation has to be controlled. The central bank will sell the government security. In return, bank will give the money to the central bank. Now they have low money supply, or they have to increase the interest rate. Ultimately, the money supply comes down with the public and the inflation is controlled, right? The another case is given on this side. So if there is recession, that means the money supply is less. That means the liquidity should be increased. So in this case, what central bank will do? Central bank will buy the government securities from the banks and the money will be given to the banks. When the banks are having more money, they can give this money to the public and they can also reduce the interest rate. Ultimately, the money supply with the public increases, and this is how the open market operations directly impact the volume of the credit in the market. So OMO refers to the sale of government securities by the RBI in the open market with the aim of influencing liquidity in the economy. Open market purchase, that means RBI will release the liquidity, that means money supply will increase, and vice versa. Now, this is a very interesting phenomena. When the government bonds and securities are sold, then what happens? When the government bonds or the government securities are sold by the RBI, then what happens? The money gets transferred to the central bank, right? So money gets transferred to from the buyers to the central bank. So the supply of credit goes down, right? That means the credit falls down. So selling of the government security leads to decrease in the money supply in the market, right? So this is the impact on the supply of money or supply of credit. There is no doubt about it, right? So this thing we have already discussed, nothing new about it. The interesting thing is that there is an impact on the demand of credit also. So not only the supply is reduced, but also the demand is also reduced comparatively. Why the demand is reduced? Because when the central bank sells a bond, then interest rate goes up, and when the interest rate goes up, the value of government securities goes down, and because the value of government security goes down, so less number of people are willing to buy the government securities. Therefore, not only the supply of money is coming down, but also the demand of money is coming down, right? So the good thing is that the supply of money actually increases, the supply of money decreases in much more proportion than the demand for credit, right? Therefore, the impact is as desired. The impact is not nullified by fall down in the demand of credit. What are the limitations of the open market operations? Number one, if the commercial banks possess excess liquidity, then OMO are not effective. So if the commercial banks are having a lot of liquidity, then even if the banks are buying the government security from the central government, still they will not be required to reduce the lending. Popularity of government bonds and securities matter, right? So these government bonds, one of the good things is that they are very much safe, they are secured, they are popular, but their rate of interest is less. So their low rate of return is one of the big hurdle. In the underdeveloped countries where the banking system are not well developed and integrated, they have limited effectiveness. So when the monetary policy transmission is reduced, then this OMO is also impacted. What is the monetary policy transmission? I will tell you in the separate session. In the unstable market economy, OMO is not effective due to lack of demand for the credit. So it is not always that the demand of government securities will be there. Now let us see the previous year question. UPSC previous year 2013. In the context of Indian economy, open market operations refers to A. Borrowing by the scheduled banks from the RBI, B. Lending by the commercial banks to industry and trade, C. Purchase and sale of government securities by the RBI, and D. None of the above. Answer is very, very simple. That is the option C. Direct question, right? So this is the next phenomena, bank rate or discount rate. So I'm giving you 2 minutes to think about it, and then we will discuss it. So to start with, bank rate or discount rate, this is also one of the very important tool of the monetary policy, right? Overall, as a concept, just understand that bank rate is the rate of interest at which the central bank or the RBI gives a loan to the commercial banks, right? So this is the rate of interest at which the commercial banks, they get the loan from the RBI or the central bank, right? This is the simple meaning. Now, how this bank rate or discount rate actually works on the field practically, to understand that thing, we have to understand few concepts, right? So I will make you understand few concepts before we understand the complete meaning of the bank rate. So let us discuss the concept of bills of exchange. So what is bills of exchange? The bills of exchange is used in case of the transactions of buying and selling. So suppose it is Mr. A and this is Mr. B. Mr. A sells to Mr. B. So in return, B should make the payment, right? So Mr. A sold something to Mr. B. In return, Mr. B should make the payment. But Mr. B says that I don't have the payment now. I promise that I will give you the payment after 90 days. So what Mr. B does? He writes on a paper and he writes that I will give this much of amount. Suppose the amount is 1000 rupees, right? So I will give 1000 rupees to Mr. A at the end of 3 months. And he writes this on a paper, he signs, and the stamp is used on this paper, and this becomes a valid document. So this document is called bill of exchange, right? So this promise which is made by the B to Mr. A that I will make the payment in future at a certain date, this is called bill of exchange, right? Now suppose Mr. A, he has got this bill of exchange. He wants some cash because liquidity is the very important aspect in the business. So he wants the amount, this 1000 rupees immediately, not after 3 months. So what Mr. A can do, he can go to his bank. Suppose SBI is his bank. So he will go to his bank and he will present this bill of exchange to the State Bank of India and will demand the money, the cash in return of that money. So Mr. A will say to the banker, sir, that Mr. Banker, please take this bill of exchange and give me 1000 rupees. You can get 1000 rupees from my buyer Mr. B after 3 months. Now, do you think SBI will agree? So why SBI will give 1000 rupees today for the 1000 rupees that he will get after 3 months? Right? Are you getting the concept? So SBI will be actually losing the interest on the 1000 rupees, right? So SBI will say to Mr. A that I will not give 1000 rupees to you. I can give only 910 rupees. So what I will do? I will cut 9% as the interest cost. And if you want the money in return of this bill of exchange today, then I can give 910 rupees to you. Right? So suppose Mr. A agrees and he gets the 910 rupees. Now SBI, the State Bank of India, has got this bill of exchange, right? Now SBI also wants liquidity. SBI is short of cash. So what SBI will do? SBI will go to its own bank, which is the RBI or the central bank, and it will say, the Mr. Bank or Mr. Central Bank, I have this bill of exchange. Please keep this bill of exchange and give me give me 1,000 rupees. Mr. RBI will say that I cannot give you 910 rupees, rather I can give you 940 rupees only, right? So central bank says that I can give you 940 rupees only, right? So what RBI is doing? RBI is deducting 6% of interest cost, and this process of presenting the bill by the bank to the central bank and the central bank giving the money back to the state bank, this is called rediscounting process, right? And this 6% is called rediscount rate or bank rate, right? So now 940 rupees goes to SBI and SBI gets a profit. How? So SBI gets 940 from the RBI and it has given how much? Sorry. So it has given how much to the customer? 910. So 30 rupees is the profit of SBI, right? And this 6%, the rate at which RBI has given the temporary credit to the bank, this rate is called rediscount rate or the bank rate, right? So in practical world, this is how the RBI actually controls the bank rate. So bill of exchange or discounting. What is bill of exchange? Bill of exchange means a written document that assures payment of money by the purchaser to the seller. So by purchaser means Mr. B, to the seller means Mr. A, for the goods purchased at a future date. So for example, 3 months. Now in the previous example, one thing you should also keep in mind, that in the previous example, after 3 months, RBI will get the 1,000 rupees from Mr. A, right? So Mr. B. So Mr. B is liable to pay 1,000 rupees to any person whosoever is having this bill of exchange. So this bill of exchange is kept with RBI. So RBI will get 1,000 rupees. So it is not that RBI will not get any amount. RBI will get 1,000 rupees from Mr. B at the end of 3 months, and RBI will also be getting a profit of how much? 1,000 minus 940, that is 6%, and this is the bank rate also, right? Discounting refers to the process of converting the bill into money at an earlier date, right? So Mr. A, he converted the bill of exchange which he received from Mr. B into the cash from his bank SBI at an early date. So he did not wait for the 3 months, rather he converted it into cash immediately, today only. Then that is mentioned in the bill of exchange or the maturity date. So maturity date is basically the 3 month in our example. Example we have already discussed, so no need to repeat again. The discount is carried if the receiver of bill of exchange needs more money urgently. And this example I have discussed with you. You take 1 minute, just read this example so that the concept is very clear to you. So the figures will little bit vary, don't worry about that, but the concept will remain same. Okay, great. I hope you have read this So this is called rediscount. The rate is called bank rate or discount rate. Apart from bill of exchange, the commercial banks get government securities discounted from the RBI. So in the example that I gave to you, in that example, State Bank of India has rediscounted only the bill of exchange given by Mr. A. But in practical world, the State Bank of India or the commercial bank, they can also discount their government security and get the cash in return of the government security from the RBI. So what is bank rate? To be precise, bank rate or the discount rate is the rate fixed by the central bank. So who fixes this rate? It is the central bank who fixes this rate, which rediscounts the first class bill. So first class bill is a category of the bill of exchange. So not every bill of exchange will be able to be rediscounted. It is not that anyone will write that I will give you 1 lakh rupees and bank will give 1 lakh rupees in return of that. So only the first class bills, some of the conditions have to be met. The credibility of the issuer has to be checked. So if Mr. B is not credible enough, then Mr. B's bill of exchange will not be discounted. So which it rediscounts first class bills of exchange and the government securities held by the commercial banks. By varying the bank rate, the RBI controls the credit, definitely. So if RBI offers discount at a high rate, that is the bank rate is increased, that means the bank's profit will be reduced, right? So if the discount rate by the RBI is high, the bank's profit will be reduced. So bank will not approach RBI for discounting, or if it approaches, then it will charge high discount rate or the high interest rate from the customer. So in this case, the customer may not come to discount the bill because the interest cost is increasing. So customer will prefer to not discount. So hence the money supply will be low, right? So the bank rate increase means the money supply reduces down, and vice versa. If there is high inflation, the bank rate will be high, and if there is low inflation, the bank rate will be low. If the bank rate is high, that means the RBI is following tight monetary policy. Tight monetary policy means the high interest rate, the liquidity is tight. If the bank rate is low, that means the bank is following easy monetary policy. That means the government wants to increase the liquidity, not the tight liquidity. Here again you can see in the language, bank rate is the minimum rate at which central bank provides loans to the commercial banks. So right, so the same thing has been written in the different language. It is called the discount rate. It is the interest rate charged on the borrowings, the loans and advances made by the commercial banks from the central bank, right? Central bank can change this rate depending upon expansion or contraction of credit flow. So if the central bank wants to increase the money supply, then bank rate will be decreased, and vice versa. So a fall in bank rate means expansionary monetary policy. So reduction in the bank rate means expansion in the money supply, and vice versa. A rise in bank rate means contractionary monetary policy. That means the monetary policy which wants to contract the money supply. The action of central bank affects the flow of credit. Rise or fall in the rate of central bank raises its rate leads to the rate change in the commercial bank. So demand for the funds by the borrower gets affected, right? So according to the rise and fall in the bank rate, the demand of the money by the borrower will also impacted. The bankers' lending rates get adjusted to the deposit rates, right? So if the bank rate is decreasing, right, that means the interest rate will be decreased. If the bank rate is increasing, that means the interest rate will also be increased. If the interest rate is increased, then the bank can also increase the deposit rate, and it can increase the deposits also, right? So rise in the bank rate reduces the net worth of government bonds. How is that possible? So I told you in one of the session that the price of or the worth of government bonds is inversely related to related to the interest rate. So if the interest rate increases, the value of government bonds come down, and vice versa. So the same thing has been written over here. Rise in the bank rate reduces the net worth of government bonds against which the commercial banks borrow funds from the central bank. So it might be difficult to maintain the high cash reserve, because with the same government bond, the commercial banks cannot get the same money. The commercial bank will not be able to arrange the cash, so it will be difficult for them to keep the sufficient cash in their bank with themselves. What are the limitations of the bank rate policy? It can work effectively only when commercial bank approach the central bank for the borrowing. So only if SBI goes to RBI for rediscounting of the bill of exchange, then only this can be effective. Otherwise, if there is no demand from the side of commercial bank, then RBI can keep bank rate at any level, and it will not be impacted. It will not impact anything. Commercial banks are more dependent upon the capital market. This is the second limitation. So commercial banks are actually now turning towards the capital market. They are not longer dependent solely on the Reserve Bank. Then change in the bank rate must influence the interest rate, which does not happen necessarily, right? These days, the commercial bank hold on their interest rate, then gets affected by the bank rate, right? So these days, the commercial banks are not actually changing the interest rate very easily. There are many other factors which actually affect the interest rate. So there is a concept called monetary transmission or monetary policy transmission. We will discuss that. So because of the problems in the monetary policy transmission, even the bank rate policy might get failed. So overall, the bank rate is rate at which RBI provides long-term borrowings, right? So this is also called as the long-term borrowing. The clients can be the government of India, the state governments, the banks, financial institutions, cooperative banks. So any of these can be the client. Now if we see the overall history of the bank rate, in 1940s this used to be very, very low. In 1990s, in 1995, this used to be more than 10%. It used to be approximately 11.5%. That means very, very high. At present, in January 2020, this is 5.65%. So this is the level presently. Now the question, 2011, lowering of the bank rate by the Reserve Bank of India leads to. So if the bank rate is lowered, if the bank rate is reduced, that means the interest rate will also be reduced. That means more money supply. That means more liquidity, right? Very, very clear. More liquidity. So lowering of the bank rate leads to more liquidity, less liquidity, no change in the liquidity, mobilization of deposits by the commercial bank. The answer is option A. Very, very simple, very, very direct question. So answer is A, more liquidity in the market. Next question, previous year question. An increase in the bank rate generally indicates A, market rate of interest is likely to fall. B, central bank is no longer making loans to the commercial banks. C, central bank is following an easy money policy. D, central bank is following a tight money policy, right? So let us start discussing each option. Option A, an increase in the bank rate generally indicates that the number A, market rate is likely to fall. No, it is actually reverse. If the bank rate is increasing, that means the interest rate is actually increasing, not decreasing. So option A is wrong. Option B, central bank is no longer making loans to the commercial bank. There is no such story, because central bank will make the loan but at a higher cost. So this is also wrong. Central bank is following an easy monetary policy. No, this is also wrong, because if the bank rate is increasing, interest rate is increasing, that means the money supply is becoming less. That means the money policy is tight. So answer is option D. Central bank is following a tight money policy. So answer is option D. Next question. With reference to Indian economy, consider the following. Statement 1, bank rate. Statement 2, open market operations. Statement 3, public debt. Statement 4, public revenue. Which of the following is or are components of the monetary policy? Option A, 1 only. Option B, 2, 3 and 4. Option C, 1 and 2. And option D, 1, 3 and 4. So friends, this is very simple question. The question is asking which of the above is or are components of the monetary policy. Bank rate is a component. Open market operations is a component. Public debt and public revenue, they are not the component of the monetary policy. They are basically component of the fiscal policy. So fiscal policy we have yet to discuss. We will discuss that separately. The point that you should keep in mind is that these are the basically the monetary policy instrument. The answer is option C, 1 and 2. Right? So bank rate and open market operations are the components of monetary policy, and answer is option C, statement 1 and 2. So with this, I really want to thank you for listening to this lecture carefully. Thank you very much again. God bless you.